Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Kaiyar. It's a red-looking Friday for our own markets. We have a lot to track, but it's time we start with the top headlines and then discuss everything on the show.
That's right. The broader end of the market seeing quite a bit of selling pressure. A fresh bout of selling causes a bigger dent in mid-caps, with declines widely outnumbering advances, while IT sees small gains. Realty, metals, along with oil and gas are the big drags.
ID stocks well off opening highs. Persistent Systems sees a sharp fall in posting a dip in profit margins. Stock down over 5.5%.
Chennai Petro is trading lower by 14% after the stock goes ex-dividend today. The dividend declared was 55 rupees a share, and the share price adjusts for the same in today's trading session.
Dalmia Bharat falls despite strong operational beat. JPA deal falling through causes capacity target guidance to be delayed.
Capital goods stocks remain under pressure for the third straight session. ABB India, Cummins and Siemens are now down between 7 to 10% in the last three trading sessions.
All right, those are the top headlines and a lot of stocks in focus, but mid-caps, of course, those are the ones, that is the one pocket which continues to underperform. Down 1.8%, markets at the day's low, and that continues to be the case across all the sectors, barring IT, which is in the green, courtesy Infosys, of course, after that good set of numbers that the company reported. But there are a lot of factors, global factors that we are talking about, and ahead of the budget, maybe the markets are assessing what kind of positioning they want to take. So yes, whatever longs that we saw are just getting unwinded now.
You're absolutely right. That's the sense that we're getting from market participants as well. Now, this is the show Midcap Movers. Hormaz is at the wall, standing by with all of the top midcaps that are moving around in the session.
From a sea of green to a sea of red now, and there are plenty of stocks that are in the red. We'll start out with the top losers, and Dixon Technology is leading the pack there. And it's been quite a bit of decline that we've seen in the last few sessions for Dixon. 5% lower today as well. Cummins is down 5.5%. MCX down 4%. CG Power also not having a good day in today's session. Some earnings reactions coming in. Persistent Systems is the one. 6.5% lower now, near the lowest point of the day. JSW Infra. Paytm was down when the results were out, but some positive management commentary has taken the stock in the green. And Dalmia Bharat also 3.5% lower after the results. Metals are having a bit of a meltdown in today's session. The metals index is the top sectoral loser. All constituents of the metals index losing anywhere between 3 to 4%. The same pressure is being felt in real estate as well. Some money being taken off the table, all constituents there as well, trading with losses of anywhere between 3 to 5%. Phoenix, DLF, Sobha, all of them seeing cuts in today's session. The PSU sell-off continues as well. There was a bit of a rebound with RVNL as one of an outlier bucking the trend, but Chennai Petro now 14% lower, some bit of ex-dividend adjustment, but there is a significant correction there. BHEL, SAIL and HAL within the defense pack is seeing a bit of losses. And lastly, some stocks that are bucking the trend in today's session, other than RVNL, Elcon Engineering has now turned negative, but then other than that, there is Tata Tele and Cyient as well that are trading with gains today. Back to you guys.
Okay, Elcon Engineering is also has to be adjusted for a split that was announced. So today was the X date, so that adjustment has to be made yet. But we spoke about Persistent Systems in that list. Hormaz, thank you so much for joining us. It is under pressure post its Q1 numbers. Their revenue came in above street estimates, but profit declined and margin contracted sequentially. My colleague Rima spoke to Sandeep Kalra, the CEO of Persistent Systems, and began by asking about the one-off adjustments to the margin. Let's listen into that conversation.
Roughly, they will be in the range of about 150 to 200 basis points if we adjust for all of these things. Because look, if you are growing at 5.6% quarter on quarter, you are also winning larger deals where you are doing transitions which are there. You're doing vendor consolidation which are there. So it's not just a simple mathematics when you're running a company that you basically say, okay, this here and so on and so forth. So it's basically a longer range play where you are winning newer contracts, you're baking in all of those transitions, you're baking in all the optimizations, and then you're looking at a longer range. How do you claw back the margins?
Do you think, there is a possibility, or is the company winning deals by being more aggressive? Is that why maybe your margins are under pressure? Or do you think you've been winning it at the same margins as before?
So it is a fact of life in IT services industry. When you're winning larger deals, when you're doing vendor consolidation, the first 2-3 quarters, when you're even transitioning, the margins take a hit. And that's there for every one of our peers. And so I don't think there is anything, as I said before, to be overtly worried about. And I think there are so many good things that are happening in the company, and we stand by our aspiration of delivering industry-leading growth with the profitability same as the last year. So I don't think there should be much concern there.
Okay, so let's talk about the good things then, right? Your revenue growth at 5.6% is the best that we've seen in the last 7 quarters and industry leading, as you pointed out. Is there a turn in the sentiment? Because this is the best in the last nearly 2 years now.
So look, there is small turn in the sentiment. I wouldn't say that this is because of the turn in the sentiment. The turn in the sentiment is people are expecting that over the next quarter to 2 quarters, starting September, maybe there's a rate decrease that happens from an interest rate perspective. And so there are positive green shoots in terms of discussions, not in terms of order wins because of a positive turn there. It's more about proactive proposals from our side. It's more about us scaling up, delivering more value, bringing platform-based solutions based on AI and so on. That's where we are winning. And just for the record, while we talked about the margins, etc., this is the 17th sequential quarter of growth, which is the highest in the Indian IT industry. The last record for that, from what we know, is 16 quarters at best, including the likes of some of the largest multinationals. So from that perspective, Persistent has delivered consistently based on our capabilities, based on our proactive proposals, based on our platform build, the AI play that we have, and that's what is holding us in good state.
Just in the near term, how is Q2 shaping up? Do you think growth will be similar to Q1?
You know fairly well we don't give forward-looking guidance, but I'm sure any smart person can look at the order wins, convert that into revenues, look at our total contract value wins that we have been announcing. So if anyone translates our ACV, the annual contract value bookings, to revenue, adds the multi-year deals that we have won, the answer is there. Balance will let the quarters pan out.
Okay. Some of your peers are calling out green shoots, particularly in BFSI in North America. And BFSI has done very well for you, a 7.5% growth. And even the run rate has hit $100 million. Talk about BFSI in particular. What has changed in the last 3 months for you? And what do you expect? What is the visibility on BFSI growth?
Right. So BFSI for us has panned out very well. It is based on both winning new business in existing accounts, some large accounts that we have, and opening newer accounts at scale against some of our tier 1 peers in the industry. So what is happening is, on one side there is demand that is kind of starting to slowly move the needle. The other side is where companies are looking for, or the customers are looking for, partners who are bringing fresh thinking, who are bringing a platform-based delivery approach to services, not just human-based approach, so that they can save money from business as usual, deploy into next generation capabilities as GenAI. And that's what has helped us in some of the largest customers and prospects, both in North America and even in regions like Australia, New Zealand, and India. So that's where we are seeing bigger wins, better wins against peers our size and bigger.
You said there's a small turn in the sentiment. Where exactly are we seeing it? Which category, which geographies, which verticals?
Yeah, so from an overall perspective, if I look at it, North America is the biggest market for us. And thankfully, North America is seeing a little bit more positive sentiment than the Europe side of it. Europe is yet to, at least for us, emerge as a bigger green shoot. So if you look at our growth, it's coming predominantly on the back of the growth in North America, growth in places like India and Australia. That is what is leading for us in terms of the growth side.
Okay. Coming back to that point about margin and the fact that FY25 margins will be similar to FY24.
Yeah.
Now, Q1 has had a drop of about 50 basis points. Q2 will have a wage impact, which will again further take away from your margin. So can you take us through the math on how you will be able to end the year with flat margins, and what will be the negative hit on your margins due to wages next quarter?
Sure. So let me give you the simple answer first, and then I'll do the maths. The simple answer is, on the wage front, 150 to 200 basis points is the impact from a negative, margin perspective as we increase the wages. And thankfully for us, we have been genuine to our employees. We have not deferred the wage increase. A lot of our peers have. If we did that, we could have maintained our margins by 150 to 200 basis points, but that's not the right way to do business. So 150 to 200 basis points negative due to that. But look, what we did smartly was we initiated cost optimization initiatives. We did a mark to market of our employee benefits, mark to market of our various policies to the best in class. And that's what we have done in the quarter one. We have taken certain hits in the quarter one so that as we get into quarter two, we are able to absorb some amount of this wage hike, hit that we will be seeing on the margins. So our endeavor is to deliver better than what would have been normally hit due to the one-times or the wage hit that we have taken. As we move ahead, the cost optimization initiatives that we have put in place, the revenue enhancement that we are seeing, all of that will pan out well. Our Q4 exit from a margin run rate should give us the cushion to bring the overall year at near 14.5% plus or minus, and then give us a run rate which is much better than that for the next few years to come. So structurally, we have done what we need to do, and we are on that path to improve our margins, as we have been saying on our earning calls and even in our media interactions.
Well, some important clarity coming in as far as the margin trajectory for Persistence is concerned. Let's now slip into a short break. When we return, we will discuss the market technicals with Sudeep Shah of SBI Securities. Stay tuned. Welcome back to Midcap Radar. We have Sudeep Shah, Head of Technical and Derivative Research at SBI Securities, who joins us for a technical check on the market. Good afternoon, Sudeep. Hope you're doing well. How are you looking at markets currently? Are we facing exhaustion at higher levels?
Good afternoon, Vivek. Absolutely. See, after a stupendous up run in the last several weeks now, we are seeing some kind of a fatigue at higher levels, 24,750, 24,800. Although on a daily basis, we are retesting that level, but from higher levels, there is some kind of a supply which is coming. And a lot of that could be attributed to the volatility ahead of the union budget, which is slated next week. So I feel overall the setup is still bullish, but there's some resistance at higher levels. So the strategy should be to add longs at lower levels, closer to 24,530, 24,550, which is an important support zone. And if you see the derivative data also, 24,500 put writers are quite strong still. So we feel that this zone of 24,450 to 24,550 could act as a strong support. And from that zone, we could see a good rebound from lower levels. And about 24,750, once we see a close above this level, then Nifty could head up to 25,000. So the strategy should be to build long slowly. 24,550 and 24,450 will be the overall support.
All right. By the way, the Midcap index has made a substantial recovery, around 370 points from the lows of the day. So it's down 917 points right now. So just watch out for that one. Sudeep, tell us, what would your individual technical picks be in this case?
Good afternoon, Sonal. See, individually, stock-wise, we like Infosys. Now, Midcap IT has made a good move. If you see the charts of Infosys, it has now crossed its prior swing resistances also in the last several months. And we feel from the current levels, this stock could do 3,000, 3,050 kind of levels on the upside, given its structure. So on the downside, the stop loss would be 2810 zone.
Okay. Sudeep, any more, or you have just Infosys for today?
No, only one, because we feel it's better to just be a bit on the lighter side.
Completely understand that. Thank you so much for joining us, Sudeep. Let's now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned into Midcap Radar and some more recovery on the Midcap index. It's down 880 now. Just a few minutes back, it was down 970. So there is a visible recovery that we are seeing in that particular index. Just watch out for that one. From the broader markets, Paytm is the one which is doing well in trade, reacting to management commentary post Q1 numbers. Abhishek is joining us with the earnings fine print. And what difference did the management commentary really make this time, Abhishek?
Well, to begin with, Paytm has reported their highest ever quarterly net loss this time around, but it was in line with expectation, especially if you take a look at the preview numbers that Motilal Oswal had put out. So total income is down 33.5% YOY and about 32% sequentially. EBITDA loss is at 545 crore. Now, Motilal Oswal was expecting an EBITDA loss of 490 crores. So contribution profit is at 755 crore. Now, again, Motilal Oswal was estimating contribution profit of 640 crores. So contribution profit margin is at 50.3% versus 56.8%, and they have reported a net loss of 840 crores, which is in line with analyst estimate. That is again Motilal Oswal estimating a net loss of 840 crores. In the con call, the management said that they expect revenue and profitability metrics to improve from here onwards. They have strong balance sheet with cash in the balance sheet being at 8,100 crores. They expect Jan 24 run rate with respect to subscriber addition to be there in their balance sheet by Q3 FY25, and they are awaiting approvals for adding new UPI users who want to be the leader on merchant payment systems. So positive commentary coming out of the management has seen the stock surge in trade today. Back to you.
Thank you so much for that, Abhishek. But Abhishek, we believe you've also been tracking Fed Bank Financial Services. It's reported its Q1. How does it look?
FedFina, the Q1 looks to be on the weaker side. Asset quality has seen some deterioration over there. So to begin with, in terms of PNL, NII growth is at 40.5% YOY and about 18.6% sequentially. They have done well with respect to net interest margin. Other income is down 11.2%, and that's impacted the net income. So net income is up only 13.4% quarter on quarter. OPEX or operating expenses grew by 39.5% YOY. And 9.6% sequentially. Operating profits are up 43.5% YOY and 18.6% sequentially. However, the provisions, they are up 230% on a YOY basis and about 98.5% sequentially. And profit they have reported is at 70.2 crores, which is up 30.3% on a YOY basis and about just 3.8% sequentially. So if you take a look, the asset quality gross NPA ratio has increased to 1.97% versus 1.66% in the previous quarter, and net NPA ratio has increased as well to 1.6% versus 1.3% in the previous quarter. Back to you.
Thank you so much for that, Abhishek, for putting light on both Paytm as well as FedFina. The other stock that I'm tracking is actually RVNL. If you could pull up the intraday chart of RVNL, in the last hour, there's been quite a bit of a spike. The reason for that is, the company has informed the exchanges that it has gone ahead and signed an MOU, a Memorandum of Understanding, with an Israeli company known as United Construction Limited Israel. What is this particular MOU for? Both of the companies will be cooperating and doing joint works in Israel, and these works, or all of these projects, would be in the field of railways, of infrastructure as well as power, where RVNL will be going ahead and giving their expertise to the Israeli counterpart. At this point of time, there are no further details in terms of what kind of orders they've received. It's just an MOU, but it's an interesting development from RVNL, and the stock is reacting quite positively in today's trading session. Yes, it's been a big outperformer, and that continues to be the case. The stock is already up 250% this year and adding on another 8% today. With that, we'll do one thing. We'll take your leave on this edition of Midcap Radar with the news that the Nifty is still down 180, but there's some recovery that we are seeing on the Midcap index. Stay tuned. Your stocks when we return.